Slate Grocery REIT, ticker SGR.UN, essentially met conservative sell-side consensus for cash flow this quarter, but they delivered a massive top-line revenue beat.
Right. Revenue hit $57.93 million, which is up, what, 10.59% year over year?
Exactly, 10.59%, and net income came in at $14.33 million, so that's a 9.58% bump. EPS landed at 68 cents, which is up 6.5%.
Yeah. But despite those really strong property-level numbers, the market's reaction was, well, incredibly subdued.
Totally muted.
Right. I mean, management didn't issue any specific forward-looking numbers this quarter. Instead, they just pointed directly to this ongoing strategic review at the corporate level.
Yeah, the strategic review.
Though they did maintain a highly positive outlook on what they're calling a structural retail undersupply.
Yeah.
But as you mentioned, the stock reaction was flat. Pre-market volume was exceptionally low. The bid-ask was hovering right around the previous close of $16.88 Canadian.
Right.
It did eventually trade near 17.71 post-earnings, but sell-side consensus just remains stuck at a firm hold.
So we have a company posting double-digit revenue growth, and Wall Street is basically yawning.
Yeah, exactly. And, the mission of this deep dive is to unpack the central tension of this earnings report for you. We're going to break down how a real estate investment trust can simultaneously post massive double-digit leasing spreads at the individual property level,
Right.
while experiencing structural compression in its bottom-line cash flow metrics at the corporate level.
Okay, let's start with that top-line revenue beat, because the main catalyst driving that $57 million figure is the REIT's aggressive property-level leasing spreads.
Oh, absolutely.
Looking at the Q2 leasing volume, they leased over 569,000 square feet this quarter, and the renewal spreads on existing tenants. Those came in at 16.7% above expiring rents.
Which is already a very solid number.
It is. But the real shocker is the new leases. Those were completed at a staggering 41% above comparable average in-place rents. Yeah. Okay, let's unpack this. A 31% bump on a new lease is just massive. It's kind of like a landlord finally turning over a rent-controlled apartment from the 1990s and, instantly resetting it to 2026 market rates.
That's a great way to look at it.
The pricing power at the property level is undeniably there. But hold on, if leasing demand is supposedly this hot and tenants are practically fighting over square footage, why did overall portfolio occupancy actually dip?
Right, it went down a bit.
Yeah, it went from 94.4% in Q1 down to 93.6% in Q2. I mean, that doesn't exactly scream unprecedented demand.
No, it looks completely contradictory on the surface, but you have to look at the actual mechanics of commercial real estate turnover here.
Okay.
Like, a drop in occupancy usually signals softening demand, sure, but in this specific quarter, that dip is primarily driven by 260,000 square feet of vacancies that just hit the portfolio all at once.
All at once, okay.
Yeah, management isn't hitting the panic button because this isn't a structural hole in the bucket. It's frictional vacancy.
Frictional vacancy, meaning like the natural downtime between one tenant moving out and the next one opening their doors.
Exactly. I mean, think about the timeline. When a tenant leaves a commercial space, it doesn't get filled the next day. You have to market the space, negotiate a complex 5 or 10-year lease.
Right, sign the paperwork.
Wait for municipal permits, exactly.
Yeah.
And then the new tenant has to physically build out the interior. That process takes months. So you have this temporary lag where the space sits empty on the balance sheet.
Makes sense.
And management explicitly noted that 4 of the 10 largest vacancies driving this dip are actually already leased, or they're currently progressing through late-stage active negotiations.
So they aren't worried about finding tenants. They're literally just waiting out the paperwork and construction phases.
Precisely. And the reason they're so confident in filling those spaces and filling them at much higher rates comes down to this massive rent-to-market discount. Right now, Slate Grocery's average in-place rent across its entire portfolio is just $13.10 per square foot. Now, compare that to the current market average for those exact same spaces, which sits at $24.79 per square foot.
That is a massive difference.
It is. What's fascinating here is that this massive $11 gap provides a long, highly visible runway for continued rent bumps. Retail investors really need to understand how crucial this is.
Because the leases are so long, right?
Exactly. Commercial leases are usually locked in for long periods. The rent a tenant is paying today at $13.10 was likely negotiated, 5, 7, maybe even 10 years ago in a totally different economic environment.
So even if the REIT literally doesn't acquire a single new shopping center for the next 5 years. They have embedded revenue growth just waiting to be unlocked every time an old lease expires and gets reset to that 24.79 market rate.
Yeah, that's the built-in growth mechanism. The landlord finally has the contractual right to close that $11 gap.
And for a local business, say a dry cleaner or a nail salon in one of these grocery plazas,
Yeah.
absorbing a rent increase like that is brutal, obviously, but they often pay it because the grocery anchor provides guaranteed daily foot traffic they just simply cannot replicate anywhere else.
Exactly. They're paying for the foot traffic.
Which perfectly sets up how those top-line leasing spreads are actually translating into property-level margins. I mean, it's one thing to sign a lease for 41% more rent, but it only matters if that money survives the operational costs of running the plaza.
Right. It has to hit the bottom line.
And it looks like it is. The report highlights that adjusted same-property net operating income, or NOI, increased by 2.3%, which translates to a $3.8 million jump on a trailing 12-month basis.
Yeah.
And listening to management's commentary, specifically CEO Blair Welch, his entire thesis for this NOI growth rests on the concept of structural undersupply.
Right. The lack of new builds.
Essentially, elevated construction costs, expensive labor, and incredibly tight lending conditions are just completely choking off new retail development. Here's where it gets really interesting. This macro environment is basically creating a walled garden for Slate Grocery.
A walled garden. Yeah.
Because no developer can realistically afford to borrow money at 8 or 9% to build a competing strip mall next door, so the existing landlord has monopoly pricing power over their tenants.
They're the only game in town.
Right. But wait a minute, how sustainable is that actually? Inflation is showing signs of cooling down. If construction materials and labor eventually normalize, won't developers just start pouring concrete again? Doesn't this walled garden vanish the second interest rates drop?
Well, that is the multi-million-dollar question for commercial real estate right now.
Right.
But to understand why management believes this moat is actually durable, you have to look at the baseline. Right now, the national vacancy rate for grocery-anchored properties is hovering around 4%.
Which is incredibly low.
It is a historically tight market. Even if interest rates drop a point or two, the sheer cost of land acquisition, materials, and municipal zoning hurdles makes new development incredibly difficult to underwrite profitably.
True.
But beyond the macro construction environment, look at who is actually occupying these specific spaces. If we connect this to the bigger picture, you see that necessity-based tenants provide incredibly sticky revenue that just doesn't care about broader construction trends.
Right. Looking at their tenant roster, over 70% of their base is essential tenancy. We're talking about massive, deep-pocketed players like Walmart, Publix, and Kroger anchoring these centers.
And those anchors are not luxury boutiques that just pack up and leave when the economy slows down or a new building pops up.
People always need groceries.
People always need groceries and medicine. Furthermore, moving a grocery store is a logistical nightmare.
Oh, absolutely.
You're talking about millions of dollars in custom refrigeration build-outs, specialized loading docks, not to mention established neighborhood shopping habits. A Publix isn't going to uproot a profitable location just because a developer built a shiny new plaza 2 miles away.
The switching costs are astronomically high.
Exactly. So those anchor tenants stay put, which drives consistent daily foot traffic, which in turn forces the smaller inline tenants to stay put and pay those 41% rent increases we just talked about.
Right.
That is why their NOI growth is highly durable.
Okay, so the properties themselves are performing exceptionally well. The legacy leases are resetting higher, the tenant base is practically glued to the floor, and the walled garden is keeping competitors out. The real estate is winning.
Yes.
But that brings us to the glaring disconnect on the corporate balance sheet. If these individual properties are printing money and the top line is beating expectations, why are the bottom line metrics shrinking?
This is the catch.
Let's dive into the cash flow compression here. Funds from operations, or FFO, dropped to 24 cents per unit. That is down from 26 cents in Q2 of 2025. And adjusted funds from operations, AFFO, fell to 19 cents per unit, down from 21 cents.
Yeah, those are the numbers the street is looking at.
Right, and just to be clear for everyone, we look at FFO and AFFO instead of traditional net income because traditional accounting forces REITs to deduct massive non-cash depreciation expenses for their buildings, right?
Exactly. FFO adds that depreciation back in to show the actual cash being generated, and AFO goes a step further by subtracting routine maintenance costs, like fixing roofs or paving parking lots.
Yes.
So AFO is the true cash left over to pay dividends.
Which makes these drops even more alarming. The true cash left over is shrinking. FFO is down to 24 cents and AFO is down to 19 cents. So what does this all mean?
Wow.
Honestly, it feels like we're looking at a high-performance engine that is somehow losing horsepower at the transmission. The properties are generating more power, but the corporate structure is springing a leak somewhere between the property line and the shareholder's pocket.
That's a perfect analogy.
And to find that leak, we have to look at the debt profile and corporate expenses. Slate Grocery is carrying $1.39 billion in proportionate debt. Now, management loves to point out that they have a 5% weighted average interest rate, and over 90% of that debt is fixed.
Well, they highlight that constantly.
But come on, commercial debt isn't a 30-year fixed residential mortgage. Eventually, those loans come due. Won't refinancing these debt tranches in a higher-for-longer rate environment completely crush their positive leverage?
Yes. That is the exact mechanism causing the cash flow compression, and it's basically why Wall Street analysts are refusing to issue buy ratings right now.
Right.
They currently have an average target of $16.47 Canadian, which is actually below where the stock is trading. To understand why, you have to look at how positive leverage works in commercial real estate.
Okay.
Historically, a REIT could borrow money at, say, 4% and use it to buy a property that yields 7%. That 3% spread is pure profit for the shareholders. That's positive leverage.
Right, standard real estate playbook.
Exactly. But as you pointed out, commercial debt is typically structured in 5 or 7-year tranches. Yes, 90% of Slate's debt is fixed right now at 5%, but when those tranches mature over the next few years, they don't get magically extended.
They have to refinance.
The REIT has to go back to the bank and refinance that debt at today's market rates, which are significantly higher.
So even if the property level NOI is going up by 2.3%, if the cost to service the underlying debt jumps from 5% to 7 or 8% when it rolls over, that new interest expense just entirely devours the organic rent growth.
Completely wipes it out.
The properties are making more money, but the banks are taking a much larger slice of the pie.
Exactly. The engine is working harder, but the debt structure is becoming incredibly inefficient. And this raises an important question about the ongoing strategic review management keeps referencing.
Oh, right, the review.
You already have elevated borrowing costs eating into the cash generated by the properties. On top of that, you have a strategic review, which is essentially a corporate black box.
And a very expensive black box at that.
Highly expensive. I mean, when a corporate board initiates a strategic review, they're usually trying to figure out if they should sell the entire company, privatize it, or drastically restructure the portfolio.
Right.
To do that, they have to hire armies of investment bankers, corporate lawyers, and consultants. These advisory fees cost millions of dollars and bleed directly out of the bottom line cash flow.
Yeah, it adds up fast.
We also saw that one of their properties, Heritage Heights, was moved to held for sale this quarter, which suggests they are actively trying to trim the portfolio to raise capital.
Right.
The problem is that management mentioned this strategic review again this quarter, but provided absolutely no clear update, no timeline, and no definitive path forward.
And if there is one thing the market hates more than high interest rates, it is uncertainty. Investors just have no idea what the ultimate corporate structure of this REIT is going to look like 6 months from now.
Which creates a massive valuation overhang. Investors are being forced to weigh incredible leasing momentum and pricing power against this corporate-level cash drag.
It's tough to model.
Until the strategic review concludes, it is almost impossible for an analyst to build a reliable model for the company's long-term cash flow trajectory.
Yeah.
You simply don't know how much cash will be eaten by advisory fees or what the final capital structure will even look like.
So to summarize the core takeaway for you, Slate Grocery REIT is essentially a tale of two realities right now.
Yeah.
On one hand, you have exceptional pricing power, massive rent-to-market discounts, and phenomenal leasing momentum at the physical property level. The grocery anchor thesis is holding strong.
Very strong.
But on the other hand, that operational success is currently being masked by cash flow compression, the looming threat of refinancing debt at higher capital costs, and an expensive, unresolved strategic review at the corporate level.
It really is a textbook example of why retail investors have to read past the headline revenue beats. You have to look at the entire financial architecture of the company.
Yeah.
The bricks and mortar are performing beautifully, but the corporate balance sheet is acting as a heavy anchor dragging down the bottom line.
Which leaves us with a final thought for you to mull over as we wrap up. We spent a lot of time today talking about the walled garden created by high construction costs and how it protects SGR's current locations.
Right.
But if macroeconomic inflation continues to cool down and the costs of construction materials and labor eventually normalize, will that spur a wave of new retail development that destroys SGR's current monopoly pricing power? Or are these necessity-based, grocery-anchored spaces permanently constrained by urban density and lack of available land, meaning they will hold that pricing power forever, regardless of interest rates?
It's a great question.
It is a structural dynamic you have to keep an eye on as the macro environment shifts over the next few years. Make sure you follow our deep dives for your daily earnings coverage so we can keep tracking exactly how these dynamics unfold. Until next time, keep your eye on the transmission, not just the engine.